Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
We start with what some described as a version of President Trump's stump speech on the campaign trail, or perhaps at a political rally. This time around, the president appearing virtually before world leaders. This was at the World Economic Forum's annual meeting in Davos earlier today. Donald Trump did take Q&A. He started with a statement, and here's just what he said. He said, "My administration is acting with unprecedented speed to fix the disaster we've inherited from a totally inept group of people and to solve every single crisis facing our country. This begins with confronting the economic chaos caused by the failed policies of the last administration." Again, these were President Trump's words before he started taking Q&A from a group of global world leaders, including B of A CEO Brian Monahan, talking about inflation, interest rates, energy, coal, AI, geopolitics, and so much more. There was a lot that he covered, Tim.
With what we need to know and more, we head to the Bloomberg News Washington Bureau with a Bloomberg News Managing Editor for U.S. Economy and Government, Mario Parker. Mario, we've got a lot to get to. Starting, though, with something that happened after the president spoke to that group in Davos. A federal judge temporarily blocking President Donald Trump from restricting who is eligible for automatic U.S. citizenship at birth. It's an early legal setback for the new administration's hardline immigration agenda. It's one of a handful of lawsuits already over the order. What does this say about the president's executive actions and the life that these may have or not have when it comes to changing the rules?
Well, I mean, this was a sweeping executive order that raised questions when he first issued it because it flies in the face of what the thinking, the long-held thinking had been around the 14th Amendment and birthright citizenship, something that had long been held as a right and just part of the country's founding. So, not sure this is surprising, but it is a setback, right? In a week that Trump has taken for pageantry to essentially celebrate his return back to the White House, this amounts to the first speed bump and test of the sweeping power and agenda that he plans to enact.
Right, and Mauro speaks to something that we were kind of all saying once he got elected, that there are things that a president can do with executive actions and orders, and then there are things that, you know, kind of the U.S. system kicks in and reminds us that it's not always so easy. Or in other instances, you know, you need something like Congress to make it all happen. Hey, I want to get to the president's had a very busy first week already. Spoke with Sean Hannity of Fox News last night, a friendly audience, if you will, for the president. He addressed world leaders in Davos virtually, and I think some of the feedback was kind of mixed views. A lot, though, say what we are hearing from the president is reminiscent of what we heard from him on the campaign trail. What, though, stands out for you? What do you think should stand out for the Bloomberg audience?
Well, I think one of the things that stands out, other than the fact that he did deliver in a World Economic Forum stage, he did deliver a campaign speech. I think a couple of things that stood out, right, was A, the broadside to Bank of America's CEO Brian Monahan. Again, that was very reminiscent of a Trump rally where he calls out those that he is displeased with. So that was one thing that was quite striking. And from what we understand from our colleagues there in the audience, it drew surprise and gasps. The other, I think, from a business standpoint, is the fact that he seems to be intent on pressuring OPEC, Saudi Arabia, namely, to lower the price of crude oil and gasoline, even amid a market glut, because he wants to essentially bring down inflation and all those things, which leads to the third part that we saw from today. He reiterated his stance that inflation, he feels, is too high, but also interest rates. He can do nothing about that, even though he said that he would demand that those that interest rates come down. But it did signal that Jay Powell is probably in for a rough ride here.
You mentioned that broadside against Bank of America. What he ended up doing was chiding Brian Monahan and catching him off guard with the claim that the bank limits business with conservative clients. He said, "I hope you start opening your bank to conservatives because what you are doing is wrong." Bank of America came out and said, quote, "We serve more than 70 million clients. We welcome conservatives and have no political litmus test." That's what a representative for Bank of America said in an emailed statement to Bloomberg.
We should point out, too, the president also called out Jamie Dimon, CEO of JP Morgan Chase, for the same alleged treatment of conservative customers. And they put out a statement, too, saying we have never and would never close an account for political reasons, full stop. Having said that, what's kind of interesting, and, Mario, we've been doing a lot of reporting here at Bloomberg about, kind of leadership around the world, certainly at least in the United States, where we see CEOs seemingly that maybe weren't necessarily supporters of President Trump, showing up in Washington, showing up in the inauguration. It is interesting to see kind of the corporate support so far that he has gotten. And some of the deals, whether it's around AI, bringing leaders together for different spends. But again, it's early days.
Yeah, it is early days, and it has been striking, especially if you recall the scenario about 8 years ago. There's a couple of things to point out there, right? The fact is, if you saw his speech earlier today at Davos, within the first few minutes, he mentioned this sweeping mandate that he feels like he has. He won all of the swing states. He won the popular vote. He invoked that as well last night in the Sean Hannity interview as well. What you're saying here, the response from corporate America and others as well, is the fact that in 2016, you couldn't say that, okay, well, he won the Electoral College. If you all recall, post-election, there was discussion about whether or not the Electoral College should be revised in some way. Well, it's hard to argue when he won the popular vote and the swing states, the Electoral College, right? These are by and large, the customers of these corporations. This does show or signal to corporations and political parties alike that maybe his support is much stronger than was anticipated, both on the campaign trail in 2024, but obviously since 2016.
That's a really good point. Hey, I just want to sort of head to wrap things up with what he said about Russia and Ukraine and bringing that war to an end. He said he wants to meet again with Russian President Vladimir Putin. He talked a lot about not necessarily making the economic or business case for ending the war, but the lives that have been lost and the lives that are at risk during a conflict such as this. What power does the President of the United States have to help end this war?
Well, he does have power in that regard, or at least it's thought to, right? The United States has been one of the biggest benefactors of Ukraine, right? One of the supporters of Ukraine throughout this all. We know that Donald Trump, at least he says that he's had a good relationship with Putin in the past. Zelensky he met with just shortly after he was elected as well. And then he's making the case that natural gas prices are tied to this, energy independence is tied to this, and sanctions and tariffs have a role in this as well.
Well, and we're going to talk a little bit later on in this hour about energy in particular, because the president can certainly set policies, but then you have the economic dynamics of drilling more and what that means for energy companies. So it's something we're going to dig into a little bit deeper. Mario, thank you so much. We know it's a busy day for you and the team, but glad we could get some time with you. Bloomberg News Managing Editor for U.S. Economy and Government, Mario Parker there in D.C.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
Oil did fall after President Donald Trump said he'll push Saudi Arabia and OPEC to reduce the price of crude, reviving a tactic to control energy prices that he frequently used during his first term in office. The Organization of the Petroleum Exporting Countries, OPEC, of course, and its allies, though, have been, as you know, engaging in a years-long effort to support prices by curbing output.
Energy is certainly one area that our next guest suggests investors should consider. Let's get to Jason Bottenfield. He's managing director and partner at Park Cities Group at Steward Partners, joining us from Dallas, Texas. Good to have you with us, Jason. We did just spend a good portion of the last 20 minutes chatting about energy. You believe it's something investors should be investing in. Why now and where specifically?
Yeah, no, thanks for having me, Tim and Carol. I appreciate the opportunity. Yeah, oil, and I was listening to Ty on the conversation there about oil and the ups and downs. It's been a good area to be in for the first start of this year here. One of the things I like about what's going to happen with oil, outside of the fact that we are producing a lot of it already, But one of the areas that I think is very attractive at this point in time is the transmission of it. So moving it through the pipelines, whether it's the natural gas or the oil, it's a dividend play. It pays out pretty well, but it can be volatile, and it is up a little bit this year, pretty good, 8-9%. But I think it's an opportunity that will continue over the next 4 years. I think because of what Ty was saying, potentially on one angle he was going with, which is regulations are going to be a little less. So that's an opportunity, I think. I think it's an area that people have looked at over the years, but might be another one to look at again.
But so the major integrated oil companies, the drillers, what exactly would you buy?
So I would actually be looking at the midstream players, which are the pipelines.
Okay.
So actually, the big refineries, I think, because the price of oil, as we're talking about, could go down to $65 a barrel, and they still make money, but that could be weight on the stock if you actually go into those, and the price does come lower if they produce more. OPEC's producing more. If there's just a glut of oil out there and the consumption doesn't meet up, but again, I think regulations coming off on electric vehicles just adds to that story that the oil is going to be flowing, the exports are going to continue to flow. There's not going to be any impacts there. So I think that transmission of the actual product is the area that I'm talking about with those midstreams that looks attractive to me.
So you mean like Cheniere and Williams companies, things like that?
Yeah, those types of companies where they're traditionally moving, the natural gas, or they're moving the oil through those lines and, moving them out and exporting them. So, those are the areas. Exactly.
But somebody watching or listening right now might be saying to themselves, hey, what happens if the oil price declines? How are these pipelines affected? Just give us an idea of what happens when to the transmission and sort of the economics there if we do see a decline in energy prices.
Yeah, there's a natural, because it is, they are tied a little bit. So, I wouldn't say it's one for one when oil goes down that the pipelines go down, but they do trade with it. So, where oil's down a little bit today, the pipelines are down a little bit today. But again, I think it really is that oil flowing is oil flowing. So they get paid almost like electric companies as the stuff moves through it. So, they just want to keep it moving. And as long as the consumption's there, the need is there, and they're allowed to move it through and we're producing it, they are the ones that are going to benefit from that and the export that goes along with it. So I think that we've all seen that Trump's not going to put many regulations on that.
Right.
And he's not going to put much on the industry. So.
Economic weakness, be it U.S. or global, that certainly would impact pipelines, right? They wouldn't have as much stuff to kind of move around.
Yeah, these are not for the faint of heart. I think you do need to do some research on these. There's been, years in 2015 and things like that where they get touched up, and especially, during recessionary periods. But I think where we're coming off of kind of a 2-year bull market, maybe going into the third, things are looking promising right now. I think it's just it's an area to where you can pick up some yield, and it's not a conservative play by any means, but I don't think it's an ultra risky play at this point.
We're also interested in cybersecurity, specifically with regard to AI. We've had a lot of folks coming on our air lately and talking about the risk of cybersecurity, and in fact, other ways to find exposure to this space through insurance and other providers of services. How do you see finding exposure for your clients?
Yeah, so cybersecurity is one of those things, right? When I think about it, is that it's going to be the last area for companies to cut, or smaller companies that don't have cybersecurity teams are going to need these outside services. So, attacking that area through an ETF where I don't have to be as specific as going into an individual stock name, can be beneficial, because, there were some touch-ups last year with a certain company in that space, and it went down, but it was actually a buying opportunity. But to avoid some of that exposure of the business risk, exchange traded funds are a great opportunity to get that exposure. It's a little bit more across the board, and some people may want to pick direct plays, but I like to go into that market with exchange traded funds, because I do get that kind of broader exposure to that industry. So that's how I play it with clients and myself.
Jason, one thing I want to ask you, we certainly ask it of all the kind of big global strategists that we talk to, the dynamics that they are using to shape investment portfolio. And I understand every client is individual. I get it. But having said that, there are big metrics that shape kind of maybe where you steer someone, even if it's putting new money to work. And so what are those dynamics? Is it what we get out of the White House, what we hear from President Trump, what actually happens in terms of policy? Is it the Fed, the first meeting of 2025 happening next week? Is it earnings where we are in that earnings season? We're going to get some big tech names next week. Is it valuations? What is it that right now is really driving how you are helping clients shape where they make investments?
Yeah, no, it's a great question. It's one that comes up often, as we're on the ground talking to clients and what they're feeling and what they're being impacted by. And, unfortunately, the story goes back to inflation. It's the biggest thing. I think a lot of our individual clients don't think of it that much. They do look at kind of the more scintillating news facts that come out, whether it's elections or policies or regulations or what's going on. But it really isn't. It really is the inflation picture, because we're really at, a lot of freezing going on across the country in some areas. I really think that we're on thin ice with the Fed and the economy. They had pretty good direction on where they could go with cutting rates. I think they may have one cut left as far as what the 2-year showing. You're seeing the 10-year and the 2-year move around. The 2-year, I think, allows them to have one more cut, but after that, it's probably going to be a pause, unless the Fed really sees that the job market isn't continuing heating up. I've been saying for 2 years, I thought that the job market needed, unfortunately, I think the Fed's looking for unemployment for them to have another basis to move lower. Can they do the soft landing and be where they're at? So I think a long-winded answer, many of your guests may be, is that inflation is still going to be a picture in 2025. And I was really hoping that coming into this year, that would be off the table and we would be talking more of the fundamentals of earnings, more about maybe what's going on with regulations or unfreezing. But it really is. Inflation's still on the table, unfortunately.
All right, going to leave it on that note. Hey, Jason, thank you so much. Jason Bottenfield, he is Managing Director, Park Cities Group at Steward Partners, joining us from Dallas, Texas on this Thursday.
AI and jobs, Carol, the relationship and what it looks like going forward. We talk about it all the time.
We do, a lot, and trying to make sense. Is it going to be complementary, helpful, more productive, or is it going to take our jobs?
Okay, well, speaking of that,
Yeah.
Earlier this month, the team over at Bloomberg Intelligence put out a report that said global banks will cut as many as 200,000 jobs in the next 3 to 5 years as AI encroaches on tasks currently carried out by human workers. Needless to say, workers are trying to figure out their place in the world of AI, and economists and behaviorists have their work cut out for them.
Yeah, one of them working on that is Kelly Monahan. She's an organizational behaviorist who is managing director of the Upwork Research Institute. That's the research arm of the platform Upwork, which matches talent with companies. She joins us right now from Orlando, Florida. Nice to have you back with us, Kelly. How are you?
I'm doing great. So great to see you guys again.
Yeah, it's great to see you as well. How are you thinking about AI and the relationship with how we work and what it means for jobs that might be replaced and new jobs that might be created?
Yeah, at Upwork, we're seeing this fascinating demand curve happen. So if we look at back in November 2022, when ChatGPT, I think, took the world by storm, what we saw happening within our labor market at Upwork was these general searches. So prompt engineering, ChatGPT, generative AI. If I'm going to be honest, I don't think many business leaders quite even understood what they were asking for. Fast forward to where we are today, early 2025, we see a much more mature market happening on our platform. And what that's meaning from a job task perspective is that freelancers today are having to become much more specialized. We realize generative AI is actually all about the data quality on the back end, and then being able to visualize it on the front end so leaders can actually do something with it. And so as a result of that, we're seeing much more specialized demand take place on our platform today.
Okay, so how do freelancers do that? What's the best way for them to make themselves, I don't want to say immune, but adjust to this new world? How do they become more specialized?
Yeah, that's a great question. So what we see happening, let's take machine learning as an example. That's always been a category on our platform for the last several years. But what freelancers are doing is becoming more specialized with that and adapting to the new tool of generative AI and beginning to develop those skill sets of data annotation, data labeling as examples, or knowledge representation we see growing on our platform, which simply means being able to make patterns and sense of the data within their organization. And so freelancers, I think what you see is those that are traditionally trained in data science and machine learning are really adapting and evolving and understanding what does that mean in light of generative AI and this new tool that they have now at their disposal.
I mean, who are these people? Are they were there and they're just fine-tuning their skills, or all of a sudden people are running out and getting trained? Like, who are these people that are now maybe considered part of the AI workforce? Well, we know AI has been around for a while.
Yeah, so what we see is two things. Absolutely, these are freelancers who've been on our platform for a while, who again have been, what we call now traditional AI, have been working in this domain for a while, and they're becoming much more in demand as they're adapting to new generative AI. In fact, like from a wage perspective, we're seeing those same data scientists who are now working alongside generative AI models command a 22% increase in their work, which I think is great. But we're also seeing new freelancers come into our platform, especially from the younger generation. And our survey work, we continue to see Gen Z in particular tell us that they prefer utilizing these, top skills that they have coming out of college and see much more stability in today's labor market by managing a portfolio of work. And so we're seeing a lot of new entries as well, especially from the younger generation on our platform.
What about from companies?
Yeah, from like a demand perspective.
Yeah, because you're a two-sided market. You serve,
yes.
You serve the folks who are looking for work, and you also serve the folks who are looking for those folks.
Yeah,
so,
absolutely.
Where are you seeing them adjust the way they're describing what they're looking for, the talent that they think they need, that sort of thing?
Yeah. So, one of the things that we haven't published, but that I see within our online platform, which is pretty exciting, is oftentimes as you think about Upwork and the demand, we see that a lot in our small and medium-sized middle market. But where we actually see some of the fastest growth right now for generative AI from a demand perspective is at larger companies, so larger enterprises. And in fact, like from an executive perspective, they're telling us about 1 in 2 executives today are actually turning to freelancers within these larger organizations to solve what they believe is an AI skills gap within their organizations. So as another example, only about 30% of full-time employees today say they're ready and willing and able to work alongside AI. And that's becoming a growing skills gap. We talk a lot about tech debt within organizations from an IT perspective. I don't know if we're talking enough about the skills debt that's within many of our organizations today as this technology rapidly, evolves and increases in demand. And I see those executives churning to freelancers to help fill that within their organizations.
Why aren't they hiring them full time? If AI is such the thing going forward and everybody's investing and is all in, why aren't they hiring full-time AI people?
I think there's 2 reasons for that. One, it's really tough because from an AI perspective, the job, like from a unit of analysis, jobs are going to, I think, fall behind. We see it's much easier to think about it from a project perspective, a task and skill perspective, because it's so new and so emergent. I'm not even sure a lot of executives know what that full-time role actually looks like today, but they certainly know they need the project or the skill set in place. And that just makes it a natural extension for freelancers, a much more natural fit. And then if we're going to be honest with you, we're in a tight job market right now. I still think executives today are hedging when it comes to full-time hiring as they, begin to navigate this market. And instead, we see much more bullish sentiment in tight labor markets. Again, about 1 to 2 executives who plan to increase hiring for freelancers. And it really helps hedge their balance sheets as they go into 2025.
Why do you think I need to turn on the mic here.
Maybe,
sometimes,
with AI
it would just recognize when the mic needs to go on.
I was worried I was talking to AI right there.
Yeah, it would be better. It would be better than me at that. I do wonder, though, about this tight labor market. Have you seen the tight labor market that you described? Because certainly we're not seeing it as tight as it was at the height of the pandemic, or not the height of the pandemic, but height of post-pandemic, I should say. Where specifically are you seeing it tight? Because you talk to some folks out there, at least anecdotally, and we're also seeing this in the numbers that come from the government, but it's not as tight as it was. And folks who are looking for work, and this is anecdotal, it can be pretty tough out there, especially for recent college grads.
Yep. So I think we're in a transitional labor market right now. And we see this anytime that technology becomes disruptive. And to your point, coming out of the pandemic, we were in an unusual time with customer behavior habits at all-time high when it came to technology companies and buying habits online. And so I think we got out of balance pretty quickly during the pandemic, and I think we've now resumed to somewhat of a normal market, but we continue to see disruption, whether it's the LA wildfires. I'm here in Florida. I saw snow for the first time in a while. And so we continue to see this climate disruption as well that I think is influencing a lot of the data that we continue to see. And so I think we're in a transitional period. I think companies are still trying to figure out, what does AI mean for the business? What sorts of talent and skills do they need within their organizations? And I think you see some hedging going on, especially in the tech space, as they begin to right-size their organizations for the demand that's actually there today, post-pandemic, as well as figuring out what is the AI development and research that I need to have done. And that's certainly an investment. And I think, again, this is where, from an Upwork perspective, we benefit from in tight labor markets. Freelance begins to be on the rise when we see markets such as this.
One thing I wanted to ask you, Kelly, is now that Donald Trump is, first week in office, he's been pretty busy. And one of the first moves that we saw really kind of had to do with affirmative action and specifically DEI initiatives, diversity, equity, and inclusion, and basically ending that for programs throughout the federal government. We're also talking about government contractors. And I am curious, since you are this great intersection of workers and companies, how that might impact their hiring, if at all.
Yeah. We actually just released a book yesterday.
Congratulations.
It's called Essential. Thank you. Yes. And because, again, it's been an amazing week to see all the changes that are taking place. I can tell you from the research, the bottom line is higher performing companies are those that have diverse talent pools. Innovation comes from diversity. I think that's been pretty well proven time and time again in the research. And so the question is going to be for companies. This is no longer going to be a requirement. It's not going to be regulated by the government. And it's going to be up to leaders now to make that choice. If they want to maintain a competitive, innovative environment, diversity still has to be a cornerstone of how they operate. And so, in some ways, I'm optimistic that some leaders are going to be on the right side of history here and continue to move in a direction that feels diversity on their own as a choice, not as a check-a-box program, that I think is where some of the frustration came from. So I'm eagerly watching this trend, but it's certainly a choice that leaders will have to make. And the research is pretty clear here. Diverse companies will outperform those that are not.
Well, so are you saying that folks who look at this from the perspective of the free market and they say to themselves, well, I want the team that does the best job, then inherently it will be diverse and sort of the market will solve this?
I hope so. At the end of the day, though, we are human and we certainly know that there's bias out there. And so I do encourage, especially like HR professionals, this needs to be regulated within your own company. You need to have the policies and programs in place that make diversity easy for your organization. And so again, this is going to be something that companies are going to have to tackle on a base-by-base basis. I want to say the free markets are going to work here, but I'm also realistic and know that as humans, we are biased. And so sometimes it may be a biased free market going on, which is why we still need to make sure that we've got the leadership programs in place to make this easy for leaders today.
Hey, Kelly, one last question. Just got about 45 seconds, excuse me. That would be a long question or a long response. First Fed meeting is next week. Dual mandate, of course, watching inflation and the labor market. How would you describe the U.S. labor market right now? You guys have an interesting, unique vantage point. So how would you describe it right now?
Yeah, right now, I think the labor market is in transition. We see this at Upwork today. We're moving into much more specialized skills. As companies get smarter with how they're using AI, it's becoming much clearer where they need the talent. And so we're a labor market in transition, and those that are being able to upskill and reskill and keep alongside of this technology, I think are going to continue to be employed. And we're certainly seeing that on the freelancer side.
All right, great to catch up with you. Thank you so much. Kelly Monahan, she's Managing Director of the Upwork Research Institute. As we remind you, it is the research arm of the platform Upwork, joining us from Orlando, Florida.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.